Hey guys, Daniel here with Value Investing with Daniel. Thank you for tuning into this video. In this video, we're going to be discussing how the best opportunities as a value investor will lie in the small and micro cap space. What do I mean? As an investor, obviously in common stocks, you have the opportunity to invest in a whole wide range of potential companies and opportunities, all the way from, the hugest companies out there like the Microsofts and the Googles and so forth, all the way down to those micro cap stocks that have a market cap of less than, let's say, 50 million or less than 100 million. What does this mean? This means that you have to be selective in your area of focus. Generally speaking, in the large cap space, there is not as many opportunities to find stocks trading at substantial discounts to their intrinsic value. But in the small cap space, in the micro cap space, there are significantly more opportunities out there available to you as an investor. So I encourage you to look for companies that have smaller micro caps, that are smaller, that have less people looking at them. That's where you're going to find the most efficiencies in general, inefficiencies. So what we're looking for really are inefficiencies between price and value. So I'll give you an example. In the small cap space, you might be able to find a company with basically no debt that makes $25 million a year consistently, has been growing at 10-15% per year, delivers good returns on capital. And like I said, let's say it's making 25 million a year and it's growing 10% per year. You can find it trading at something like 100 million. So 4 times, let's say, earnings. I mean, that is a really good discount and definitely well below its rough intrinsic value. So if we were to calculate a rough intrinsic value for it using a sort of an approximate discounted cash flow analysis, we could see that that sort of company would be worth substantially more than what it's trading for. And so when we're looking for companies that have, let's say, huge margins of safety and huge discrepancies between price and value, it's going to be in that small and micro cap space that we find more opportunities. That's not to say that we can't find good opportunities in the large cap space and mega cap. We can, it's just that they're significantly more rare. A recent example would be Meta. Meta had a conservatively estimated intrinsic value of about 600 billion, but it was trading at about 200. So meaning we could buy Meta for basically 66% off. And so when you have huge discrepancies between price and value, you're going to often find that that occurs in the small and micro cap space, not in these huge companies. It's relatively rare, although it does happen. I'll give you a couple of examples. One example that I like to use, which is in my own portfolio, is Sleep Country. Okay, now I bought Sleep Country at about $20 a share a couple of months ago, and it's already up at 26. And the reason for this is when there's a substantial difference between price and value, eventually those two will converge. And so I want to give you an example. So ultimately, a company is worth the discounted future stream of its cash flows. So meaning, a company is worth what it's able to generate in free cash flows over a long period of time, discounted back to its present value. If we look at a company like Sleep Country, on average, it's made $506 million a year in free cash flows over the last 5 years. We can plug it into a simple discounted cash flow calculator that I have. The next thing that we need basically is a growth rate. What we can do is we can look at the revenue growth of the company, let's say over the last 5 years, and we can take what the average revenue growth has been over the last 5 years of about 12%. And let's be conservative and say it'll only grow at about 75% of that rate in the future, so 9% per year. We get a conservatively estimated intrinsic value of Sleep Country to be about $1.2 billion. If we look at the enterprise value of Sleep Country, meaning what it was trading at, when I bought it about here, I bought it at about $770 million in terms of its enterprise value, meaning I got a substantial discount to its intrinsic value. If we're saying I paid 770 million for it and it was worth 1.2 billion roughly, that means that I got it at quite a substantial discount. I only paid about 63% of what it was worth. So When you see opportunities like that, remember this was a conservatively calculated intrinsic value calculation that we used. When you can find companies that are trading at such substantial discounts to their conservatively estimated intrinsic value, then you'll be able to make extremely great results within your own portfolio. Another example of a company that I really like is Smith& Wesson. And I'll show you what that looks like here and what I saw when I bought it. So I bought it at about $8 a share, and it's already up to about 11 very quickly. But I'll show you when and why I bought it. If we look at the free cash flow, it's been averaging about $118 million worth of free cash flows. And we've got to figure out what a good growth rate is for it. Again, we can look at revenue growth. Its revenue has grown on average about 7% per year, but let's say we want to be conservative and choose to only grow it at about 5% per year. We get a conservatively estimated intrinsic value of about $1.1 billion for the company. We look at what it's been trading at in terms of enterprise value. When I bought it, it was about 300, or let's say about 400 million. So we estimate the intrinsic value is about 1.1 billion. I bought it for 400 million. And so what happens is when there's these great discrepancies between price and value on magnitudes of, the price being basically 50% or less of the conservatively estimated intrinsic value, what will happen is, generally speaking, over the next 6 months or so to a year, the market will correct that inefficiency by driving the price up. So that's something to keep in mind. The best opportunities out there are going to be in the small and micro cap space. You can definitely find inefficiencies in the mega cap and large cap worlds, but they're just going to be more rare. We can look at Meta as an example of that. If we look at Meta, now Meta skyrocketed basically from its bottom, but if we try and calculate, approximately what a conservative estimate of Meta's value is, we can use its 5-year average free cash flows as a base. So we can say 24 million. And we got to come up with a growth rate. Again, we can base that off of its historical revenue growth. So it's grown its revenues very, very quickly. But let's say if we want to cap that off at 20% per year as our absolute maximum, we can say that, Meta is probably worth somewhere around 490 billion, very conservatively, 490 billion. Well, if we look at its enterprise value, what it was basically selling for, it's shooting up towards that figure now, but you would have been able to buy it at basically a 50% discount. If we look just over the last year, right, you would have had the opportunity to buy it around here at 210, 220 billion. That is more than 50% off. And so what happens is when you can find such great inefficiencies in the market between price and value, eventually the price will sort of shoot up towards the value, usually within the next 6 to 12, but sometimes up to the next 18 months. So it's something to keep in mind. This is obviously not the only thing that you have to do. You'll also have to look at other factors, but keep in mind that within the small and micro cap space is where you're going to find the greatest inefficiencies within the market. Thanks for watching.